So we're investment managers, and as such, we have a weakness for data. We like data, and we like information points. And this slide, what this slide seeks to do is it just seeks to present 119 years of ASX market returns in one single slide. There's a few things I want to discuss regarding this slide. First of all, the negative-based years are all in red. So first thing I want to highlight to everybody in the audience is, guess what? Every once in a while, markets provide negative-based returns. So a bad year in terms of equity markets is not a year where you have a 2 or 3%, but it's a year in which your total market-based return starts with a negative. And you'll see that there are a few data points there in that slide. In fact, statistically, in 119 years of ASX history, the markets fall on average 19% of the time. So in 19% of the years, you're going to have a year that provides you with a negative-based market return. So on average, almost one in every 5. The other point when I look at this slide is that it's predominantly green. That is 81% of the years the market provides you with positive returns, and that's a very important fact to remember. The other key highlight I want to establish is when you get negative-based returns, they don't seem to last for a number of years. In fact, you've only had 4 occurrences over the last century where you've had 2 years of consecutive negative returns. That were in 1915, 1916, 1929, 1930, 1951, 1952, 1973, 1974, and the last one was 1981, 1982. So statistically, it's a rarity to have 2 consecutive years of negative-based returns. The interesting thing is in those occurrences where you did have 2 years of consecutive negative returns, the following periods were actually very strong upward trend in markets. So you see after 1916, you had a period of 12 years of very strong market returns. Same as in the depression of the 1930s, you had a huge bull market that lasted for a decade. 1950s, post-Second World War period, you have a very strong bull market. The 1970s, early 70s economic crisis and the oil crisis, the first year you have a tremendous bull market, 62%. And even in our most recent strong bear market, which was in 2008, you had a very strong 2009, and the markets actually recovered quite strongly, say for 2011, which was the European debt sovereign crisis. But in all the period post 2008 can be summarized as a strong bull market. So the conclusions are that statistically, if you are a long-term investor, you have to accept the notion, and you should only be an equity investor if you're prepared to be a long-term investor. You should accept the notion that you're going to have negative-based market returns. So a bad year in terms of equity investments are not single-digit positive returns. A bad year are anything that starts with a minus. And if you're investing for a 5-year plus period, which should be the bare minimum, 5 years should be your bare minimum investment time horizon if you're going to be exposed to equity assets, you should expect at least 1 year of negative-based market returns. The second key point is it's very likely the majority of your years in a long-term investment horizon are going to be positive. And you have to keep that in mind as you're enduring that year of negative-based market returns. The third point is strong bear market declines have historically been followed by very strong resurging bull markets that have historically more than offset the bear market declines. i.e., the bottom line is it pays to be invested over the long term. It pays not to react during negative years. In fact, if you look at the chart, if you had decided to sell at the end of any of those negative years, you are foregoing far greater upside than the downside that you've actually happened to incur. It pays to be long-term invested. That's the key takeaway. Only invest in equities if you are prepared to take a long-term investment journey. We would qualify any investor that is seeking an equity investment with anything less than a 5-year investment term as speculative in nature and subject to market timing risk. That's the great thing about long-term investment, is that it gives the investors the luxury of avoiding this whole notion of when to invest in markets. And if you do that, this chart demonstrates the long-term rewards. This is a chart showing the ASX accumulation index for the last 40 years, and we've charted the annual index return performance. And as you can see, it's not a straight line. And I always tell our investors, be prepared to incur market losses through calendar periods when you invest with us. There are going to be periods where market prices go down. Those declines are not necessarily related to a fundamental decline in the equity value of the underlying assets, but they are just the vagaries of market movements. However, long-term investment does provide you with a formidable chance of having terrific long-term investment outcomes. And the journey is a long one, but it's a rewarding one for those that are seeking long-term investment outcomes.